The best macro call of the decade ended in total liquidation. On the 24th of July, a hedge fund manager wrote to his investors to report a 439% return for 6 months of work. 6 days later, $16 billion of that portfolio was sold in a single morning. Not because he wanted to, because he had to. He wasn't wrong, he was financed. A 25-year-old built a multi-billion-dollar fund on a single physical constraint thesis. Situational Awareness LP, founded by the Leopold, 25 years old, fired from OpenAI, no professional trading experience, backed by Jane Street and the founders of Stripe. The whole fund came out on one essay he published in June 2024 that AGI could arrive in around 2027, and the binding constraint wouldn't be intelligence. It would be physical, compute, memory, power. The strategy followed directly: own the constraints. The portfolio architecture maximized exposure to the hardware buildout. By early July 2026, the fund approached $45 billion. Three pieces: long AI infrastructures, SK Hynix, CoreWeave, Vistra, Oracle; short application softwares that called SaaSpocalypse trade; and a private stake in Anthropic, roughly a fifth of the book. Underneath all of it, one engine. Every dollar of equity control about $4 of the market exposure. A hedge that shares your core thesis is simply a second bet. That structure looked like a hedge. It wasn't. The long AI hardware and the short application software aren't two opposing bets. They are the same macro view expressed twice, which works beautifully until the theme reverses. On July 28, Adobe rallied almost 5% on an earnings beat while the broader tech sectors fell. Both legs of the portfolio lost money on the same day. At 4 times leverage, a 25% market correction is a 100% wipeout. Now, add the leverage: $100 of equity, 300 borrowed, 400 at work. The book rises 10%. Your equity is of 40. That's the version that produced 439% returns. The book falls 25% and your equity is gone. All of it, 100%. In July, SK Hynix and SanDisk fell between 35 and 50% in weeks. On July 29, 2026, every macro and fundamental vulnerability collided. Then came July 29, when everything landed at once. SK Hynix reported record profit and still missed consensus. The stock fell around 19% intraday. Korea triggered a circuit breaker for the second consecutive day. The Federal Reserve held rates, with officials dissenting for a hike. No dovish rescue coming. And the long end of the bond market sold off. Across that single week, cheap stocks lost more than $1 trillion in the market value. The 24-hour liquidation of a $16 billion public equity book. The next morning, Goldman Sachs, JP Morgan, and Bank of America issued margin calls. There was no time to sell down carefully. $16 billion of public equity moved as one enormous block trade into Citadel in about 24 hours. And then the irony. The moment the market knew the forced sellers was gone, the buyers came back, and the asset had just been liquidated out of rallied. Leverage silently rewrites your holding period. So, why did the fund die when the thesis didn't? Because a thesis has origin, and financing has one too, and they were never the same length. His ran to 2030 and beyond. Margin financing runs one day. Your lenders does not care about what happens in 2030. Your lender cares what your collateral closed at today. Leverage doesn't just amplify your returns, It silently rewrites your holding period. A 10-year position financed at 4 times isn't a 10-year position. It's a one-day position you have to win again tomorrow. Forever. Survival was dictated entirely by the observability of the price, and the proof is sitting inside his own portfolio. The public book was marked to market every day, so it could be margin called. So it was liquidated. The Anthropic stake was not marked daily, so it could not be called. So it survived. Around $10 billion retained. Identical thesis, identical conviction, opposite outcome. That position lived purely because no computer could put a price on it at 4 o'clock every afternoon. Crowding transformed a market pullback into a synchronized fire sale. He also wasn't alone in the trade. When positions are crowded, one fund's forced sale becomes the next fund margin trigger. Asian fundamental long-short funds fell 18.6% in July, the largest drawdown on Goldman's record, driven by the largest 5-day exposure reduction the bank has ever tracked. Though note this, most of those funds were still up on the year. The industry didn't die, the leverage did. The index was calm because its components were destroying each other. And here is what made it so hard to see coming. Through all of it, the VIX sat at about 16.5, calm. Meanwhile, Sendix fell 56% and SK Hynix 47%. Index level volatility measures the average. In a dispersion regime like this one, the average conceals the event. It was credit event before it was an equity event. The earliest warning wasn't in equities at all, it was in credit. An AI capex boom projected to top 3% of the US GDP requires enormous off-balance sheet financing. Hyperscalers' capex expectations climbed towards $690 billion, and credit default swaps on borrowers like Oracle widened past 100 basis points. Credit questioned the debt before equity noticed the danger. The mechanics of a liquidation are immune to the genius of the thesis. None of this is new. 1998, a genius thesis at 25 times leverage liquidated. 2021, extreme concentration and hidden swap leverage liquidated. 2026, the most correct macro call of the decade. At 4 times visible leverage liquidated. Correct thesis, concentrated bet, borrowed money, and the thesis become irrelevant due to the borrowed money. The final lesson, which leaves one lesson: market do not pay you for being right, they pay you for being solvent when you are proven right.